What's going to happen to interest rates when the Reserve Bank meets next week? With speculation about interest rates an almost daily event, it's worth weighing up the pros and the cons of an interest rate cut. What could the effects be to our economy and to our property markets? Now, most commentators now seem to believe that the next move in interest rates down. In fact, the Reserve Bank's already proposed that, saying it's going to happen, but not when. So are they going to cut next week? It seems like the majority of commentators are suggesting they will, with some even suggesting it's the first of up to 4 cuts in rates. But interestingly, there are advantages and disadvantages to cutting interest rates. So let's talk about the pros and cons in this week's Property Insider discussion with Dr. Andrew Wilson, Australia's leading independent housing economist. Welcome, Andrew.
Thank you, Michael.
Well, Andrew, I guess the factor that tipped the market predictions, that changed people to say it's going to happen this month, the interest rate cuts, was the surprising weak inflation reported for the March quarter.
Well, there's certainly those inflation numbers they were flat, Michael, over the March quarter. It certainly was a result on the downside of expectations. But, inflation really has been just trundling along the bottom for a number of years now. This is a phenomenon that's we're not alone in sharing in advanced economies. Really, low interest rates and stimulus from monetary policy has failed to ignite prices growth. And this is a conundrum for all central banks who really have been stuck in this nowhere or no man's land of not being able to activate economies with the usual levers of monetary policy.
So, Andrew, what's the problem with low inflation with falling prices?
Nothing. That's the point. I mean, isn't that the perfect world? We don't have falling prices, Michael. That's a different environment. We just have a very weak inflationary position, and that is prices aren't rising by much at all. And in isolation, isn't that a perfect world where we have prices flat and incomes rising? And that's the point. You can't look at inflation on its own in isolation as a factor in monetary policy. I mean, this has been the mistake, I guess, that policymakers have made.
Well, let's go through some of the arguments that some of the people are making for an interest rate cut, because there are people suggesting it's not the right time. I'd love to get your opinion at the end, but let's go through the various ones. So the first argument people are saying that why we should have a rate cut is because inflation is weak, and by reducing interest rates, it's going to give people more spending power, businesses more ability to borrow money cheaply. And if they could spend more, they'd buy more things, boosting the economy, and normally everyone wins. But it doesn't seem to be as simple as that, does it?
Well, it's not, Michael, and I don't think an interest rate cut will have much impact, will make much of an impact on the economy. I think I've always had the view that interest rate cuts and monetary policy is a momentum driver. It's about the cycle, in a sense, that you create momentum for growth or to rein in growth according to your monetary policy settings. Now, we've had a record period with interest rates on hold, pushing up towards 3 years, and that means that momentum is lost. So the capacity to reignite or to dampen economic activity, as is typically what we use monetary policy for, has been lost because the momentum's not there. And I don't think we've got enough ammunition in the kit bag to recreate that momentum. And I'm horrified to hear those predictions of up to 4 interest rate cuts, which would bring us down to 0.5% interest rate. We've seen the problems that the Eurozone and the US got into with very, very low interest rates. So it makes it even harder to reinflate your economy to come up from that level.
Another argument people are using, a reason they're giving we should lower interest rates are because house prices are still falling.
Yes.
The rate of fall is less, but it's affecting consumer confidence, and therefore people aren't spending. And some are suggesting a rate cut would ease the downward pressure on house values and inject confidence back into the property markets, Andrew.
Well, I think that would only be marginal if it occurred, Michael. We're not going to see the type of cuts to interest rates that we have that stimulated the market in 2013, 14 and 15. It's, again, I think it's overstated the impact of the housing market on the economy. If we look at previous cycles. I think it's, putting the cart before the horse, looking to stimulate the economy through the housing market.
There's an easier way in my mind of helping stimulate the housing markets again. Interest rates are low. The challenge, though, is getting finance, particularly for investors, where the banks are measuring your serviceability on an interest rate of maybe 7.25%.
Yes.
So your real rate is going to have a 4 in front of it. So I think it'd be much easier if the regulators wanted to boost the housing markets to allow borrowers' capacity to be increased by dropping that serviceability criteria. I don't know, maybe 0.5%, 1% or whatever. And that will all of a sudden give people the ability to borrow more, if that's the issue that they had, Andrew.
I think they should just leave well enough alone, Michael. There's been too much tampering and tinkering with monetary policy in relation to the housing market, whether it be restricting, macroprudential policies, restricting investor activity. We've become so risk averse that we've actually created the situation we was trying to avoid. It doesn't make sense to have an environment where we're all talking about interest rates cutting below perhaps 1%. And yet we've got this, this safety net well in excess of that, and it would take, many, many increases in interest rates to get to that risk level, that safety net level, and that's just quite absurd now. We'll struggle to see an interest rate with a 2 in front of it, perhaps for a decade.
Another reason some people are suggesting there should be a cut in interest rates is it would lower the value of the Australian dollar, and this would be good for our exporters, particularly resources, as they get more money for the same services, the same iron ore, the lump of iron ore that they're selling or whatever. Would that be a reason to cut interest rates, Andrew?
Well, look, there's swings and roundabouts on this, of course, Michael. A lower dollar, I think, would have a significant effect on the dollar. That's more a product of what's happening in the United States, and the US are now starting to think about maybe even cutting their interest rate going forward, but certainly no rises there. So the American dollar determines really where our dollar is in terms of our export market. And of course, yes, it's good for exporters, but it's not so good for the domestic economy because it brings in higher prices for imported goods. And that's the last thing we need, given that it's consumption that's the black hole in terms of what's happening in our economy. Low incomes has restricted people from purchasing. That's kept consumption, which is 60% of GDP, flat. If we had higher prices coming in through higher imports, and of course that would mean fuel as well. That would have a negative certainly in a short-term scenario of consumption. So, and the other point is that our export industries aren't really, even though it's good in terms of the GDP number and the balance of trade, they're not really strong generators of, in the shorter term anyway, of employment.
Well, as we're working through a list of some of the arguments, some of the commentators and economists are out there giving why the interest rate should cut, there's another one, Andrew, which says spending is softening. They're saying about a third of households have got a mortgage, so lowering their interest rates would give them more disposable income. They could spend more on goods and on services, or they could pay down their debt. And the suggestion is that would be a good thing.
Well, look, of course, Michael, that's more money in your pocket through lower interest rates. But, we're seeing the market adjust now with a number of banks have announced cuts to interest rates over the last couple of weeks. And that is because that overseas borrowing costs are falling, so they can no longer justify higher interest rates because of higher interest rates overseas. So borrowing costs have come down. So I think that the other point, of course, is that when we look at the number of households with mortgages, we only look at around about 5% of those mortgages are those with lower levels of equity in their property, which would tend to have higher levels, or they would be the households that would be more inclined to spend an interest rate cut. The other thing we ignore, Michael, in terms of interest rates cuts is that it's not good news for those that rely on fixed incomes through deposits in banks. It's already very tough times for those particularly older Australians who rely on fixed incomes and deposits in the bank. Those deposit numbers are very low. Interest rates are very low now. And if they got even lower, that would have a negative effect on what might be a similar amount of Australians who rely upon interest rates or income from fixed, with fixed incomes on cash and term deposits in the bank.
So clearly there's, for every argument,
yes,
others are putting for interest rate cut, there's arguments not to. Let me give you another one. There's a long standing argument from the Reserve Bank saying that they want to keep inflation between 2 and 3%. And there's a risk that the public loses confidence in the Reserve Bank's inflation targeting regime. So is it that the Reserve Bank is going to do this just to push up interest rates to prove themselves right?
Well, that would be very concerning, Michael. Again, this is this sort of rule book economics that's got us into trouble in a sense. I mean, I'm not overly critical of the Reserve Bank. They have to justify what they do. Now, that target, that 2 to 3% target, obviously doesn't reflect the real world now in terms of macroeconomics. And as I said at the very beginning, Michael, we can't look at inflation in isolation. Maybe we've got to start really looking outside the square, and as well as having an inflation target, we have an incomes target as well. As I said, we've always been used to the fact that if we get inflation right, then everything else falls into line, you know, in terms of the jobs market, in terms of wages increases, and in terms of the general economy. Now, that just hasn't worked now. It's a different world now. And let's start thinking about, you know, the real issue, and that is trying to get incomes increased. Now, that's going to be a real journey, and I wouldn't be too concerned about low inflation. The latest wages data, Michael, is a bit more positive. It's certainly not great, but the trend now appears to be gradually moving upwards. So as long as we've got at least two of the big three, that is incomes and the jobs market, looking reasonably positive, you know, that leaves just that inflation issue on its own. We can't look at that one factor in isolation.
Okay, so I've gone through some of the reasons that some commentators are suggesting we should cut interest rates. So let's look at the reverse arguments. There's people out there saying we should not cut interest rates, or not us, the Reserve Bank shouldn't. And one of them is that it would add more fuel to the bubble. We've already spoken that there isn't a property bubble, but property prices are falling. And so would it actually reignite the property markets again?
No, it wouldn't, Michael. We don't have enough, as I said, momentum. We don't have enough energy to do that. I think we're evolving into a very positive period for our housing markets. It will be much lower growth because we're going to have a much flatter business cycle, which means reflecting a much flatter interest rate cycle, which means a much flatter house price cycle. So more predictability, more certainty coming forward. Some green shoots appearing now as confidence returns very gradually to our housing markets.
Well, some people would say would just encourage more debt, because if debt's cheaper, people are going to take it on. How do you feel about that?
I don't agree with that argument at all, Michael. We've actually seen the proportion of mortgages in terms of repayments of the family income has actually fallen the last 5 years, despite high prices growth. We can't look at just house prices in isolation. We should look at what the repayment scenario is versus the income levels.
See, unfortunately, there are people out there talking about a debt bubble and we've taken on more debt than ever. The problem is they've got it wrong, because the debt in general is in the hands of people who can afford it. When you look at mortgage default rates, Andrew, they're the lowest they've been, other than if you go to out north in Western Australia, in the middle of nowhere in the mining towns. We haven't got a debt problem, have we?
No, we haven't in that sense. I mean, mortgage defaults would obviously be a key indicator of issues with debt, with people being unable to service their loans. Now, that typically rises, those mortgage defaults, when people lose their jobs, which is, you know, not rocket science again. In those areas where, as you suggested, Michael, there is higher unemployment, you have higher mortgage defaults. But as long as we've got a strong economy in terms of the labour market, which we do have, then people are in a position to pay off their mortgage, and any changes are really at the margin in terms of arrears and defaults. And, you know, predictions of a debt bomb and predictions of house prices falling by 40%, possibility of falling by 40% this year, I think some predictors made. They've got a long way to go, because house prices in Sydney anyway are down by around about 3% so far this year. So I guess there's going to be a lot of catching up over the next 9 months to get to that 40%, Michael, which is...
Boy, are we going to have a rough time. You're right.
Well, and I think the rate of decline is also declining, Michael. So yes. Even the trend looks like it might struggle to even get to double figures this year, and even less, maybe even 5%, with most of it happening in the first half of this year. So that's a long way short of 40%, Michael.
So we're talking about the reasons some people are suggesting we should not cut interest rates. And one of them is that we've got strong employment, we've got jobs growth. And that's one of the things already, Andrew, you suggested is holding the Reserve Bank back, because they've said along the line that it's not just inflation, they're looking about jobs growth. Another one is income tax cuts are coming. That's actually going to give people more money in their pocket after they put in their tax returns this year.
Well, look, it is more effective in a sense because it covers more of the population. Income tax cuts, Michael, rather than perhaps interest rates. I mean, I'm not suggesting that there would never be a case to cut interest rates. The point with, concerns over a weakening global economy is that unless we really have all the factors lining up irreversibly in terms of negativity, then we should hold our fire in case we do need it down the track sometime. So it gives us some capacity to cut if we really need to cut down the track in circumstances beyond our control, such as a global downturn.
Okay. Well, what about the fact that we're in the middle of an election campaign? Well, I know in the past, changing monetary policy during an election campaign risks the central bank being caught up in a political fight, saying they're on this side or that side. Is that going to come into their consideration when they have their meeting next week, Andrew?
Well, it should, of course, not, Michael. It's it's all about monetary policy, and if the case is strong to cut rates or to increase rates, that should happen.
We've also said that it's bad for some people. You've already mentioned that an interest rate cut would be bad for people in retirement or living off their cash deposits in the bank, the little that they get back. And it'd probably also be bad for first home buyers if it does push up the property values a bit. But I think an interesting argument is that the low inflation environment isn't a local problem, so don't try and solve it locally when it really is a worldwide problem. Competition from foreign workers, automation of jobs, keeping a lid on wages and prices. The Reserve Bank can't do much about those forces, can it?
Well, it can't, Michael. And as we've suggested, the nexus between jobs, inflation and wages, prices and wages, has been broken. We've had strong jobs growth, low unemployment, but it hasn't delivered the wages growth, which has not delivered the consumption, which hasn't created the demand to push up price. And a lot of that, Michael, is because of migration, that we've been able to soak up extra supply of jobs by record levels of migration. Now, that's provided us with income tax relief because of increases in the PAYE tax paid into the government coffers through all these increased jobs, but it hasn't created the competition between workers to push up wage. But this is the new world, Michael. Get used to it. Stop playing by the old rule book. You'll only cause more problems than you solve.
So clearly, there are reasons for an interest rate cut, reasons against an interest rate cut. But Andrew, if I get it right, your suggestion is that the RBA should keep its powder dry this time round.
Well, for the time being, Michael, I would suggest that they need to look very carefully at the wages data which comes through next. If that falls back, if the wage index falls back again, there was some growth in the private sector in the last wages data that came through. I think if that doesn't look like consolidating, I then think that's now 2 out of 3, and that's good enough reason to cut rates moving forward.
So if it cuts rates too soon, it won't have the firepower later on if things get worse. It'll be really see what happens next Tuesday. I look forward to chatting with you next week and we can see what happens, Andrew.
Well, it's just because we think this is the right decision doesn't mean it'll be the decision that's followed, right?
Well, the government pays them a lot more than it pays you and me to make those decisions, Andrew.
Well, maybe there's a lesson there.
We'll see what they come up with. Thanks for your time.